Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, August 14th, 2013. In this video, I'd like to do a quick update to the S&P 500. Did an extensive video on that last week, I believe it was, so I won't spend too much time. And then move in and just take a look at the top components. I'll just discuss the top 10 holdings of the S&P 500. As some of you know, I like to do that from time to time. These top weighted components, where they go, the rest of the market is most likely to follow. So let's start out here by looking at the daily chart we're looking at on the S&P 500. Actually, I'm using the SPY, the tracking ETF, as a proxy. And I've been discussing this rising channel here. And on the last video, we were still above that channel. I mentioned these sharp divergences in place, which indicated we'd likely see some downside in the near future. And we did get a breakdown actually on Monday. If you look at the crosshairs here in this candlestick, we did break below that trend line, the bottom of the channel. Came back on Tuesday to backtest it, just a perfect kiss of the channel below underneath, as you can see this candlestick here. And we remain below that channel. So we have broken down, which was my next sell signal that I wanted to see. As I've mentioned recently, I'm putting a lot more focus on the longer term charts, meaning the daily and weekly charts right now, than I am on the intraday charts. For those of you successfully trading the intraday charts, more power to you. This market it looks like an EKG lately with these sharp, opening gaps down in the morning, being bid back up. You look at the short-term charts. Most of you know what I'm talking about if you follow the markets closely. Here's a 5-minute chart. So good luck trading in this slop and chop. That just shows me that the momentum is clearly waning in the market here. Is it possible the market's consolidating and waiting for working off these overbought conditions and wants to punch up higher? Sure, but that's not my read on the market. Admittedly, I had been overly bearish earlier this year. We did have some divergences in place earlier, as I talked about, and they did play out for corrections, although not as deep as I expected. However, now we have these very sharp and clear divergences in place, which I believe will lead to a more considerable, substantial pullback in the market. So that's the daily chart. We again have broken down below the bottom of the channel here, or this uptrend line. And let's take a look at the weekly chart real quick, something I've discussed. Again, these were the earlier divergences in the year. If you follow the vertical line up, that's where the blue divergences here on these blue lines were put in place when the MACD or the PPO on this weekly time frame and the RSI put in these lower highs against prices making higher highs. And we did have, from that point, this correction that brought us back down to this uptrend line. So again, just to reiterate from the video last week, overall the bigger picture remains bullish on the S&P as far as from a pure price perspective. And by that I mean I discussed we had the 2007 highs here, the previous all-time highs in the S&P 500. The prices broke out, made a bullish breakout, and a near textbook backtest of that level. And that in itself is bullish action as long as prices remain above those 2007 previous highs. But as I said, with the divergences in place, we still have, as prices went on to make higher highs in these new recent highs, unfortunately for the bulls, we have continued to diverge, meaning the RSI, the PPO, the MACD, just about every indicator and oscillator has put in lower highs while prices made those higher highs. So in other words, that's negative divergence. It's pretty pronounced, and I would say, although anything could happen, anything's possible at any time, I do expect a correction to manifest itself very soon. In fact, I believe that the highs are in. The highs that we put in early August will most likely be the highs until we see a pullback to this level. Maybe I could see a marginal new high. And again, anything is possible. Prices may want to continue just going up for the next few weeks. That may happen as well. But I do see a pullback to come in, maybe one more back test of those 2007 highs, this horizontal line right here. As well as I've pointed out, we have this uptrend line, which was extended off this earlier wedge here. I've extended that blue trend line, as you can see, prices came back, and when they made that back test of the 2007 highs, they also back tested this previous upper wedge trend line. And now what I'd be looking at, let's draw this out here. Um, an ideal bullish scenario would be a move back down to these intersecting trend lines. We have this lower downtrend line, this, I'm sorry, uptrend line, this blue uptrend line as well, and those previous 2007 highs where we back tested. So maybe a move back to that level, followed by a sharp move higher. That would be a very bullish technical event there. Help work off some of these overbought conditions, help burn through these divergences. However, if we were to move down, I'd expect some type of reaction there. But if we were to move down and then break below all these three intersecting support levels here, then that would open the door for a lot of selling, and more than likely at this point, shortly after, we'd see some of the longer term trend indicators flip over from bullish to bearish. So this is going to be, in my opinion, a key battleground right here. Call it the 155 to 160-ish level. Let's keep it easy and say around 155, 158 on the S&P, or at least on the SPY, that is. Okay, moving forward to the top 10 holdings or top 10 components of the S&P 500, we have Apple at number 1. Apple and ExxonMobil have, for the last few years, played piggyback with each other as to who is the largest company by market capitalization, and Apple recently regained that title. Some of you might remember a few months back I was watching a potential inverse head and shoulders pattern. Inverse head and shoulders patterns are bullish patterns, and we had what appeared to be a left shoulder here, head here, and at the time I pointed out this right shoulder. Now, what may have happened since then, if you can visualize, we're looking at, of course, a candlestick chart, but if you visualize a line chart, you would have a solid line from this point down. You wouldn't see this gap. You'd have a line down here, and then prices moving back up. So what may have formed here is somewhat of a complex inverse head and shoulder pattern. Complex just meaning you have two shoulders on each side. So this would be your first left shoulder, second left shoulder, head, first right shoulder, second right shoulder. Now, the second right shoulder is really a little bit too long, almost as long as the head is, the pullback there, which these patterns should have better symmetry. But with that being said, this may be what's playing out here. We have this, this was the same neckline I had drawn on the pattern at the time. And if you look at price action, since we broke above the neckline, came back to make a back test. Let's zoom in a little bit here. Came back to nearly back test, and we've moved up sharply. I know a lot of this is the Carl Icahn noise lately, his stake in the company and pushing for a share buyback. But that's just noise in my opinion. And in fact, I'd be more apt to sell. I had some Apple that in my personal accounts, one longer term account, I unfortunately sold too early back here. One family member and still in the stock, and we've put a trailing stop in. We're just trailing it up here. On an inverse head and shoulders pattern, if you take the distance from the head to the neckline, which was about right here, and you add that to the breakout level, that gives you an approximate measurement for the pattern. So that would project all the way up there to the 550 mark. However, I do see some pretty formidable resistance on Apple here, and it's getting pretty stretched in the near term. So my guess is it doesn't have a lot of oomph left in it, at the very least until we get a consolidation. So, Apple may have a little more upside. Near term, I wouldn't even come close to getting in front of it on a short right now, but I wouldn't be chasing it long here either. That's just my personal opinion. Okay, let's get rid of this, and we'll move on to the next stock. By the way, Apple, if I didn't mention it, was weighted in at about 2.81% weighting in the S&P 500 as of the most recent figures that I have here through, I believe, August 12th. Here's ExxonMobil, XOM, and this is the second largest component, coming in at 2.66% weighting in the S&P 500, so really right up there with Apple. Definitely a much more bearish looking pattern. ExxonMobil, we're looking at a weekly chart here, weekly time frame, and we have this large rising wedge pattern with multi-year, very clear and solid divergences in place. Prices continue to make higher highs, 1, 2, 3 successive higher highs. with both the RSI, the PPO, just about every indicator out there, oscillator, failing to make higher highs there. So we have negative divergence in place on the weekly frame. Let's take a look here at the monthly chart. Here's a monthly, a very long-term channel in ExxonMobil going all the way back to the mid-80s. And as you can see here, prices broke down. They actually managed to hold that level during the financial crisis, during the last bear market, and didn't break down until 2010. Broke down, came back in, but they've been flirting with the bottom of that channel, which I have two parallel trend lines drawn. It's not a very well-defined bottom lately, but either way, it looks like prices are significantly losing momentum and are clinging to the bottom of that channel with divergences in place as they go on to make new recent highs or test those previous highs. So negative divergences on the monthly frame. Here we're looking at a weekly chart. Again, I zoomed this one out a little bit more. So this is a 10-year period. And again, I talk a lot about these divergences. This was the pattern leading up to the 2007 highs in the market. ExxonMobil managed, like a lot of the energy stocks, to actually make they peaked in early '08. Energy was one of the last holdouts during the last bear market. But if you look at going into the highs, we had clear negative divergences in place. Just as on the flip side, during the bottom, we had strong multi-month positive divergences in place. The purple line here, might not see it too well in this video. There's a purple line right here. Prices made a lower low against the PPO, RSI, most indicators making a higher high, and that led to the bull market that we're in now. And again, this is a weekly time frame, so we're looking at, in this case, multi-year divergences leading up to the highs. This was over a year and about a year and a half divergence leading up to the lows, and now we have clear, unmistakable negative divergences put in place as prices wedge higher in this contracting bearish rising wedge pattern. We've also we're challenging these previous highs. And now, as you can see, if we zoom in closely, this is a pretty well-defined uptrend line here. These are the 2010 lows. We have quite a few tags of this trend line. And, we had a few breakdowns below that trend line intra-week. But if you look at this candlestick, we really zoom in, you can see that's a long wick, which means prices managed to close back above the trend line by the end of the week, which is what you want to see on a weekly chart. And now we're pretty well below that trend line. We're talking Wednesday, so we'd have to see quite the fireworks from ExxonMobil to get back up inside that wedge. And really based on where we are this close to apex and having failed at these new highs, recent attempt at new highs here, that to me, this stock has already broken down, and in my opinion, the next easily 10 to 20% in this stock is much more likely to the downside than to the upside, in my humble opinion. Moving along, Johnson & Johnson, this is component number 3 at a 1.71 weighting. From this monthly chart, this is very bullish price action. We had quite the resistance level here around roughly 70-ish. It's hard to see on this scaling, but quite a few tags, tag. Finally, we broke out to new all-time highs recently, and the stock has just been on fire. Very suspect breakout. Volume's been questionable. You can see here on this volume at price histogram a lot of the trading, and we had a nice base that we did break out of. So still healthy action, longer term. However, in the short term, it's rare to see such a mega cap company, a blue chip dividend paying stock like Johnson & Johnson become so overbought. Here we're looking at a weekly RSI reading of over 90. So very overbought. Although that in itself is not a sell signal, it is a caution that you really don't want to be chasing the stock at this point. You want to let it come back to you if you're bullish longer term. Some of you might recall I had Johnson & Johnson's a short on the site on a breakdown a few months back on this rising channel here, and I had listed this as the first support area. I had it labeled as minor support at the time with my targets down here. Well, it turned out it was major support. The stock did find support there, tested for a couple weeks, and then blasted off again. However, from that point, it has set up into a pretty distinct and very steep bearish rising wedge pattern. And as you can see, The steeper the pattern is, usually the more uh, impulsive the selling once the pattern breaks. And as you can see, the stock has come down hard in just the last few days here, from about the 94 area all the way to, we're almost, we're below 91 now, and bearish MACD crossover. So my guess is this stock has really gotten ahead of itself. It would be healthy action really to see Johnson & Johnson come back, pull back, at least retrace 50%, if not more, of this breakout here to all-time highs. So again, like a lot of these stocks I'm looking at, I think the next 10% on J&J is more than likely to the downside from current levels than to the upside. And again, where these top holdings go, the whole broad market is likely to go with them. So let's move forward. General Electric. Here's a daily chart. This is the trend line to watch. Here's a pretty well-defined uptrend line. Prices are diverging as we make a higher high here, or recently made a higher high. The MACD, the RSI have failed to do so. So this negative divergence tells me that the momentum is running out, and what we need to watch for is a move down to at least test this uptrend line. Maybe one bounce from there. Maybe we break down. But again, these divergences have been building since earlier this year, going all the way back to February when we peaked out here, and are likely to play out in the upcoming weeks to months here. Here's a longer term chart, a weekly chart, goes back 10 years. As we can see, this is really where GE fell off a cliff. And looking at the histogram and some other things, these reaction highs, this is a resistance zone that I have. So I'm looking at GE from a weekly perspective, wedging up. Prices are wedging higher, running into this resistance zone. With, just as with the daily, these are different longer term divergences, clear negative divergences on the PPO, the RSI. This was just a monthly trend line which GE broke. This was a multi-decade trend line going back to the mid-80s, which was broken down in the last bear market. So that's GE. If prices somehow continue to manage to work their way higher, here's a downtrend line for you longer-term traders to watch, something that could come into play in the next few months should the market and GE move higher. And here's Mr. Softy himself, Microsoft, symbol MFST. Microsoft comes in at the fifth largest component at about 1.62% weighting in the S&P 500. And these two horizontal lines here mark a resistance zone. Again, we're looking at a weekly chart here. So there's 10 years of price history on this chart. And these arrows, I've discussed this chart in the past, they coincide with these overbought readings. So you really don't want to be chasing Microsoft when the stock, when the RSI reaches overbought levels. More often than not, as you can see, just look at the price action following each arrow. Those overbought readings on the weekly time frame lead to a sell-off. We've also recently had a bearish crossover on the PPO, and if you look below those overbought readings on the RSI, you'll also notice that you typically have a bearish crossover on the PPO as well at the same time. So what did we have recently? Another extreme overbought reading. And if you look here, back in the 2007, the end of the last bull market, just before the financial crisis and the bear market that went into early 2009, we had this, what looked like a blow-off top. You see prices just run up in a near vertical. That's not even parabolic. It started out parabolic, and that's basically a vertical run, typically referred to as a buying climax or blow-off top. And that broke out to new highs, which of course, from a price perspective is bullish, but it turned out to be a giant bull trap sucking in the last of the dumb money, where the institutions hand the money over to the retail, hand the stock over to the retail investors. So we know what happened following there. That doesn't need much more explanation. Now, what do we have here? A near vertical, definitely a parabolic, what could be another blow-off top. Same conditions, overbought conditions, bearish crossovers. Now we've pulled back. We're right at the bottom of that support zone. Now this could be, eventually this stock may break out, and at some point Microsoft could easily clear this level. So this may be nothing but a back test of that support level. Although it would have been healthier to see it back test up on the high end of the support zone. So now where we're at the bottom of that support zone, and if Microsoft goes a lot lower, then I think we can say with a higher degree of confidence that this was a blow-off top, i.e. bull trap, and that could lead to quite a bit of downside in the stock in the months to come. Okay, I'm going to continue to try to talk fast to get through these in the shortest amount of time. This is Google on a weekly time frame. Google's position number 6 at 1.58. This was bullish. We had a failed breakout actually back a few months ago. Failed breakout to new highs. These were the previous highs back in '07. That breakout failed, but shortly after that we powered back through, and Google is now trading in clear skies, all-time highs, meaning there's not any overhead resistance. So that's bullish from that perspective. However, it's not really drawn here. I'll have to update this if I can grab this trend line here. Prices are diverging. They were diverging up to this point. We had that correction, and if I were to add another trend line here, as prices continue to move higher from this point to this point, if you look down below, I'll add this to the RSI. We're failing to make higher highs. We're making, in fact, lower highs. So that brings this breakout into question. Again, just like the broad market, it would be probably a bullish event to see Google come back here, back test those highs again. Here's the long-term trend line that comes into play, so maybe we back test somewhere around this area and hold. That would be the bullish scenario. However, a breakdown below these intersecting support lines would have longer-term bearish implications for the stock. And let's just take a look while we're on it at the daily chart. I've added some Fibonacci fan lines here, the purple lines. And as you can see, we've moved up these fib fan lines, and they've acted as support and resistance. First, this breakdown of the first upper line, pierced below it very temporarily, and then shot back up, tested the line from above, have found support all the way here, broke below, came back and back tested. So it's interesting to see how these lines work. Now, I don't set the duration. If anybody's played around with these, you set your first line where you want it, and the rest are filled based on the Fibonacci sequence. So interesting to note that we are now at support on this Fibonacci fan line. So let's see what prices do from there. This is a daily chart again, and as you can see, when prices made this recent new all-time high in Google, there were some very sharp divergences on both the RSI and MACD. So not surprising that we've had this correction so far, nor would I be surprised to see additional downside in the stock from Chevron Texaco comes in at number 6 at 1.5% weighting. This is a long-term, multi-decade trend line going all the way back to the mid-'80s, which, as I talked on recently, I expect prices to come and they haven't visited or tested this line in years now, and I wouldn't be surprised at some point, more than likely probably in 2014, to see prices come down here and at least come and test this line, sort of a reversion to the mean, if you will. If you look at, again, on a monthly perspective, very long term, going back to 2007, we have prices clearly wedging higher in a bearish rising wedge pattern, strong divergences in place, multi-year divergences, excuse me. We take a look at a weekly chart. Here's that wedge shown a little more clearly. This is the key trend line to watch, the bottom of this wedge. If we break below this purple trend line, we have strong divergences in place, and my guess is this will lead to a sizable correction in Chevron Texaco. So that is a level to watch. Procter & Gamble monthly chart, going back to the mid-'80s. Here's a long-term trend line, and as you can see, this stock looks like it's wedging higher. Had a few flirts with this long-term uptrend line recently, and we're not far above it. And as you can see here, long-term divergences, the RSI, PPO, they're all failing to make higher highs along as the stock makes higher highs with prices. Weekly chart, I covered this recently. We had this sharp blow off top back in '07, this sharp move. Prices made higher highs, as shown here, 1-2, while the RSI made lower highs. And so far, we've actually equaled that high here, I believe, if I'm not mistaken. We'll zoom down to the daily chart. So we have equal highs. I haven't updated this chart. And we made a considerably lower high, I should say, in the RSI. Now, from a pure price perspective, just like the broad market, we broke out of made a new all-time high here, took out the 2007 highs, came back and back tested. That's healthy price action so far. However, based on the look of these charts, I wouldn't be surprised to see at least another backtest. And where we go from there, again, will be very important. Um, Procter & Gamble can either power higher, burning through these divergences, or if we did break down, you have to watch those trend lines that I discussed. And let's see if there's anything on the daily chart. Nope. Daily chart shows, these divergences and how they play out. Last time we had divergences in place were right here. We had, if you follow the vertical line up, prices made that higher high while the MACD and RSI below, if you follow the vertical line again, made a lower high. And as is most often the case, I should say, we had a correction from that point. And then what happened from there, prices moved higher in a very steep rising wedge. And if you look at this point here, in other words, we had divergence from here to here and here to here inside the wedge, and then boom, very sharp correction. In fact, if we drag the arrow, the correction really didn't end until this point. Prices did power back up to re-challenge those highs, but never got any higher. And so that is really the magnitude of this correction based off these divergences. Now, what's gone on since then? Let's clear this out a little bit. As you can see, prices now are really putting in a triple top pattern. We have three roughly equal highs here, while the MACD and RSI continue to diverge, putting in lower highs. And triple top pattern works something like this. If you take a look at the base of the pattern here, this horizontal line I've drawn, measure the distance between the top and the bottom of the pattern. If prices move down to the bottom, which I do expect based on these divergences, if prices were to come back down to the bottom of this pattern, an official triple top pattern breakdown would occur on a break below this line here, the base of the pattern around the 75, 50-ish level. And if you add the distance of the pattern to that breakdown, this would give you your price measurement. However, this wouldn't be my target. If P&G were to get down to this level and again break down from there, this line here, I see some nice horizontal support here around the 71 level, so that would be my target. But of course, the other option is Procter & Gamble breaks out. If it breaks out of this triple top pattern and breaks out to new highs, a sustained breakout, and we can burn through these divergences, that is the bullish case. So that's something to watch for. But as of now, with the divergences in place, as I said, more often than not, these play out. So my expectation is a move down, probably at least towards the base of this pattern in the near future here. Wells Fargo, I don't have a very strong opinion. Probably looks better than most of the stocks in the S&P 500, at least the top holdings that I'm looking at here. We do have negative divergence, if you notice, from this peak to this peak, where prices overshot the top of this channel. We had divergence on the RSI with it putting in a lower low. However, the MACD actually made a slightly higher high. Still, with that being said, based on the extended nature of this channel here, the fact we had this recent overshoot, I'd expect prices to at least come back to revisit the bottom of this channel. And then where we go from there, of course, if prices broke below the channel, that would be a technical breakdown and likely portend additional downside in the stock. And the final top 10 holding is Berkshire Class B. And we're looking at a daily chart here, and what I've drawn is this channel. If you look at this upper yellow line here and this bottom lower yellow line, we actually have three tags which make validate this trend line. And so what I've done here is added this midpoint. Now it's not exactly in the middle, however, you'll note it's a parallel line. This orange line is a parallel line to the bottom of the channel and the top of the channel here, even though it's slightly just south to the center of the channel. However, take a look at how prices have behaved. It's done a very nice job of acting as support and resistance. When we were down here early in the formation in this channel, we would find resistance at the center point line, come back to the bottom of the channel, resistance, pull back. Finally, we powered up through it on that strong gap and move above. And since then, as you can see, that prices have really done a good job of finding support right on that line. Now, based on these divergences, all along, we did have some divergence back here that played out for a mild correction, but now we have some pretty nice negative divergences in place on this recent high, and my expectation would be a break below that. So the next sell signal, I don't have this as a trade idea, but for those of you interested, the next sell signal would be a breakdown below this center point line and a move down to the lower end of the channel there. Okay, and wrapping this up, those are the top 10 components of the S&P 500. And again, my thought process is because of their weighting, those are, the top 10 outweigh. I don't have the stats in front of me, but it's quite a significant weighting in the whole index. So where these stocks go, the market's likely to follow. So that's my take on the S&P 500. I hope you enjoyed it. This has been Randy Finney with Right Side of the Chart. Have a great day.